bank margins have been in a massive headwinds that we've been in this low rate environment.
Hi, I'm ggoernert, Senior Investment Advisor at Canaccord Genuity Wealth Management and ggoernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, today, I'm going to be joined by Canaccord Genuity financial analyst, Scott Chan, to talk about banking. Scott, how are you?
I'm doing well, Greg. How about yourself?
Very good, very good. Hey, thanks for joining me today. Right now, many of my clients, we're talking about inflation. We're talking about interest rates, something a lot of them really haven't seen. I mean, my older clients have seen it. I've seen it back in the when I was a kid, back in the 70s, in the early 80s. Really want to talk about how this affects your sector, the financial sector in general, and maybe some banking and on the insurance side in particular. So why don't we talk about just the economic backdrop, and then we can talk about, what that means to the sectors in general.
Yeah, Greg. So I would have said about 3 months ago when we had this inflationary and interest rate rising expectations, it wasn't as profound as it is today. It seems like every 2 weeks, the inflation figures get larger, specifically on the consumer side. And not only the Fed, but the Bank of Canada, in terms of the implied future rate hikes and the vast velocity of it, certainly has or should have ramifications on the economy and in the financial sector. From a numbers basis at the start, we did a PNC report that cited that rising interest rates were generally good for banks and the life cos. But you kind of fast forward 2-3 months, the fact that inflation is running so high, the fact that it could happen a lot quicker than people suspected, there could be some negative offsets that we're really watching. One is a lot slower growth, and that's what the Bank of Canada is trying to do. And two, from a credit perspective, as you know, we've been dealing with such a low rate environment for so long, and now that we have it creeping up, I think people worry about debt service levels, the ability for consumers to pay, and ultimately bank credit, which is pristine right now. Maybe looking out to next year and beyond, there could be some worries if we hit a recession and credit losses really spike. We really haven't seen that right now, Greg. We're really monitoring the market, not only just in North America, but the global market in terms of all the economic indicators. But most of them are pointing net negative recently, which is obviously impacting the overall stock market, not just with the financial sector.
Yeah. So, generally, just for those who haven't, had a chance to watch our earlier videos in this, generally a higher interest rate environment, and I'm talking in general terms, is usually a net positive for the banking sector because they borrow short and they lend long. But, in a rapidly rising interest rate environment and, potentially a stagflation environment, what does that mean? How is that, I guess our last time that we've been through something like this would have been, the mid-70s? How did that look then, and how do you see it playing out this time?
Yeah, so you're right. Like in terms of a P&L perspective, like higher rates do benefit bank margins. And bank margins have been in a massive headwinds that we've been in this low rate environment for a while. And we actually put a nice piece out in terms of the sensitivity on each bank in terms of who's got the best earnings sensitivity to rising rates, like 100 beep rise in rates. And TD would benefit most, and BNS would be on the bottom end. And at that point, even after a robust fiscal Q1 reporting, everything seemed pretty rosy with the banks, and the bank valuations were trading above its historical range, say above 12 times with excess capital. A lot has changed intra-quarter in terms of the macro environment. The banks just reported fiscal Q2 results. They were very solid. But as you know, the market is forward-looking, and not just over the next 6 months, but into 2023 and into 2024. Stagflation would certainly be a negative in the economy. I think the Bank of Canada, is looking to avoid that situation. Slower growth, which we're seeing right now in certain pockets of the market, like the housing market. But if you look at other lending or important lending categories for the banks, they're really going to provide an offset for at least the back half of the year. So if we think of like credit cards, where credit cards have been down during the pandemic, and now that COVID, hopefully, there's everything is a lot more lifted. People are just spending a lot more. So card growth is really regaining momentum. And then if you look at businesses and commercial, they're coming back as well. So commercial growth has been leading this recovery over the past couple quarters. And into the back half of the year, we think the commercial portfolios will provide support for overall bank growth. So growth, is going to be subdued, but I think in a stagflation environment, it would be more subdued, and perhaps we're looking at kind of flattish or low single digit growth in that scenario.
Okay, let's talk about the elephant in the room before I want to move over to the insurance sector. But a lot of clients ask me, particular top of mind is the residential real estate portfolios of the banks, and how does this affect them going forward if we're having higher rates? In particular, a lot of the rates in the past have been, or the mortgages in the past have been variable mortgages. How is this all going to play out as far as the mortgage book looks and future lending potential?
Yeah, so the mortgage books for the Canadian banks have been, I would say, a massive tailwind during the pandemic, not only from a growth perspective, but also from a credit perspective. From the growth perspective, even as of last fiscal Q2, Greg, the industry in Canada is growing at low double digit mortgage growth, and that's significantly higher than the 6%. I would say growth over the past 30 years. That said, over the last couple of months, we've seen sales decline. In the back half of the year, the banks have targeted a lot lower growth, so low single digit growth. And we kind of put fiscal 2022 all together. We're probably looking at growth 6% that's in line with the historical average, and probably lower next year. The second part, when you kind of look at mortgages, because it's so important for Canadian banks, comprises 35 to 55% of the overall loan portfolio. So, it's a pretty good indicator of bank performance and bank valuation in the past. So you have to look at credit, but I think the consumers are in very, good situations. Although banks are ramping back mortgage growth, future profitability on potential mortgages with a rising rate environment is probably higher than what it was during the pandemic. So that's going to provide some offset there in terms of what you're going to see in the financial metrics on housing and mortgage portfolios. The market always reacts very quickly, Greg. If you look at a lot of the Canadian housing exposed stocks in Canada, look at the Alt-A guys like Home Capital Group and
Yeah.
First National and Equitable Bank, like they've been hit really hard from a valuation perspective. And I would say CIBC has been hit hard the most from the Big Six perspective, because they have the most exposure to residential mortgages out of the Big Six. So it's something that we watch very closely. I think the market overreacts a lot very quickly in terms of the
Always.
valuation. But I would say net over a cycle, over many cycles, the banks manage their mortgage portfolios pretty well.
Okay, now let's move across to the insurance sector, because that might be a bit of a different story. However, I got to refresh my memory. A potential stagflationary environment. What does that do to the insurance portfolios, in particular annuities, and how that all plays out?
I would say the life codes that I cover, Greg, are a bit different, in terms of the macro sectors. One, because they're more diversified, like Sun Life and Manulife are in Asia. They have U.S. exposure. They have a lot of asset management and wealth. So it really is a different beast, I think, when you look at the life codes versus the banks. The one interesting point is that in a rising rate environment, life co profitability is better, similar to the banks, or should be
Right.
better, especially over the medium term. If you're not seeing it right away because of the different accounting standards, you are seeing in that multiple expansion, and we're not seeing it right yet. There's a lot of headwinds near term with the Canadian life goes. So we're a bit cautious, I would say, over the next 3 months, because they are switching to a new accounting regime called IFRS 17, which is very confusing to the public. So we're getting education sessions from the regulators and from the companies that have to transition over. COVID-19 is still lingering in certain areas, specifically in Asia, where Manulife and Sun Life have big operations. So it's impacting policyholder experience, like mortality, morbidity, disability, and then whatnot. And if you compare life cos versus the banks in terms of asset management and wealth management, life cos have a lot more exposure into those market sensitive or equity market segments. That, as markets have been very difficult globally year to date. Flows have turned negative, so they would have more of an impact on my space in the Canadian life co side than the Canadian banks would.
Okay, hey, let's just jump back to banks for a second, because during the pandemic, um, we had the OFSI rules, in particular, requiring the banks to hold back capital. Those have, I guess, as of last fall, been relaxed, and so we did see dividend increases in the banks. What is the tailwind of that going forward? Has that kind of played itself out so far?
Yeah, I think it's played out a bit better than we expected in terms of where capital is today, where we thought it would be, say at the start of the pandemic, and in terms of just the capital deployment into dividends and dividend growth. As you know, once OSFI did lift that restriction last fall, all the banks and life cos did a one-time catch-up dividend because it was pretty much halted for the prior couple of years as per
Mm-hmm.
OSFI. And what we found during this recent fiscal Q2 bank earnings, the dividend growth expectations that was initiated, especially from Royal at 7%, National at 6%, were a lot higher than our low single digit forecast. So the banks and the life cos are back to, or the board is back to looking at dividend growth every other quarter, similar to what they did pre-pandemic. But I think that, as I said before, in terms of the fiscal Q2 bank earnings, the higher dividend growth, the more incrementally positive outlook than what we would have suspected, I think is a near-term positive for bank stocks relative to life co stocks.
Okay, let's leave it there. Thank you so much for joining me again. Great insights, especially in difficult times. And we've had difficult times before. We'll have them again. We'll get through this, but really appreciate your insights. Scott Chan, Canaccord Genuity. Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.